Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs and proud co-founder of the Dividend Kings website. Please allow me to take this opportunity to welcome and thank everyone who has placed a confidence in our group. We're very excited about the Dividend Kings, and as a group we are very committed to giving you the very best possible investment advice on investing in high-quality dividend growth stocks possible. With this first installment, I'm going to look at the true dividend king, Parker Hannifin Corporation. This is an industrial machinery company that has increased its dividend for 63 consecutive years, which makes it a true dividend king. As many of you know, dividend champions and dividend aristocrats increased their dividends by 25 years or more. True dividend kings have done it by 50 years or more. And again, Parker Hannifin has done it by 63 consecutive years. But I'm going to try to keep this video short. I'm going to look at one metric here. I'm going to look at adjusted operating earnings. And so to start off, I'm going to take price off the graph and the normal PE because it's virtually identical to the fair value estimate PE. What I want you to note here is that this company is moderately cyclical from the aspect that occasionally we get moderate drops in earnings, but over time it is clearly a growth stock. The company's average earnings growth has been 9.17%. And this is the real message I'm trying to get across with this video. When you invest in a company at fair value, which is represented by this orange line, and in this case it's a PE ratio of 15, offering an earnings yield of 6.67%, which is a long-term average return on stocks. What happens is, if you buy this stock when it was at or near this triangle here in the beginning and hold it, it's going to eventually, the price is going to track the company's earnings growth. And you can see in the case of Parker Hannifin, that correlation between price and where the company's earnings growth has gone is very, very highly correlated. Now, I also want you to notice there are times when prices get temporarily disconnected from what I'll call the operating results of the business. Here's a case where it got undervalued. Here's a case where the earnings dropped, the stock price overreacted and dropped beyond what earnings would justify. But then as earnings recovered, the company's stock price soon recovered. Then you see a period of overvaluation here, and we had some overvaluation at the beginning of 2018, the end of 2017. And since the beginning of 2017, we've seen this reversion to the mean where the stock price got back into alignment with earnings. And then it's been kind of vacillating here, but again, still tracking earnings over time. Now, here's what's important. This stock started out approximately in value and ended up approximately in value. So what that means is, and this is what I really want to get across with this message, when you buy a good quality stock that's growing its business, in this case moderately sporadically, you are positioning yourself to participate in how well the business does or the operating results of the business. So we have 9.17% growth. We bought the stock at fair value. It's ended almost at fair value. So if I measure performance here, I would expect that my growth would be somewhat equal to more or less the 9% historical operating growth that the company achieved. So if I go into the performance calculator here, and I'm using this on a $10,000 investment, had you bought the stock on its fiscal year end, May 31st, 1999, and held it through yesterday's close, and that's fair value to fair value, I want you to notice your annualized rate of return would have been 9.1%. That's essentially identical to the long-term growth rate, slightly less because there was some minor valuation discrepancies here. So you end up getting this, turning $10,000 into $57,000, and that's significantly better, by the way, than the S&P 500 did over this time frame. You can see it just slightly doubled your money, but I also want you to see the dividend advantage. This company has grown its dividend on average at about 10.6% and a compounded average growth rate of 10.3% over this time frame. Note that these are 3 quarterly dividends here. This is not a full year yet. But the point is, that $10,000 investment would have generated $8,900 in dividends versus $400 to the S&P, giving you a total return of $66,000 or 9.9, we'll call it 10%, versus half of that or 5% in the S&P 500. The key point here is when you buy a good stock at value, you participate in the growth of that business, and your rate of return, your growth component of your total return, will equate to the growth of the business. Plus, you'll get this additional kicker, if you will, from the dividend income. And as you can see, the dividend income of a dividend king such as Parker Hannifin is much more consistent and reliable than even the earnings number, which is moderately cyclical and certainly more consistent and predictable than the black price line, which is one of the major underlying themes of the article. Now, going forward, I do believe this is a very attractively valued dividend king. I think it offers some really interesting midterm returns. I think it offers some decent shorter term returns. And, the growth expected over the next couple of years is to average about 10.86%. That's essentially in line with what the company's historically done. These numbers are never perfect. From a standpoint of a longer term trend line growth, there are only 3 analysts, but they expect about 7% growth. That would still give you very nice long-term rates of return. So here we have a dividend king with a proven history that, I was able to show you a stock that was fairly valued in the beginning and is basically fairly valued or moderately undervalued at the end, to simply illustrate the point that investing at fair value is so critically important, because it does position you as a shareholder / partner / owner of a business to participate in the business. And after all, as prudent, value-oriented, fundamental, long-term dividend growth investors, that really is what we're looking for. This is a stock that I think you can have confidence in. It's A-rated, which is a very strong investment grade rating. It only has 37% debt to capital, and it's a very well-managed company with a management team that's committed to paying us dividends. So Parker Hannifin would be my first installment. This would be a very prudent investment. And by the way, nothing I've said here suggests that the price couldn't drop from here in the short run, as I mentioned in the article. But in the long run, I believe if you invest in this company at these levels, which is a PE of 14.38, which is giving you an earnings yield of about 7%, I think you'll do very, very well in the long run. And that's what prudent investing is all about. Anyway, welcome again to the Dividend Kings. We're glad to have you on board. We really appreciate everybody and all the confidence you've placed in us, and we look forward to continuing to earn that confidence over time. Thanks for reading, and thanks for watching.